In the space of just 24 hours this week, the two most powerful central banks on the planet effectively redrew the map of the global currency market. On Wednesday, the 17th of June, America's Federal Reserve held rates yet signaled hikes ahead. On Thursday, the 18th, the Bank of England did the same. And here is the striking part: despite both standing still, the pound tumbled to its weakest level since early April, slipping 0.5% to around $1.32. Standing still, it turns out, can move markets just as violently as cutting or raising. If you trade, travel, import, export, or simply hold savings, the decisions made this week will ripple through prices for months. So let's unpack exactly what happened, why the dollar is suddenly back in charge, and what the smart money is watching next. Start with the world's reserve currency. On the 17th of June, the Federal Reserve left its benchmark rate unchanged at 3.5 to 3.75%, a fourth consecutive hold. But this was no ordinary meeting. It was the very first chaired by Kevin Warsh, who has replaced Jerome Powell, and markets were repricing everything around him. The real shock came in the projections. The Fed's so-called dot plot showed 9 of 18 voting members now expect a rate hike before the end of 2026, with 6 penciling in 2-quarter-point rises. Crucially, the Fed sharply revised its inflation forecast, lifting expected PCE inflation to 3.6% from 2.7%. Higher energy costs, driven by conflict in the Middle East, are the culprit. The message was blunt: the next move may well be up, not down. The reaction in the bond market was immediate and telling. 2-year Treasury yields, which track expectations for Fed policy, jumped 14 basis points to their highest level in over a year. And the relationship here is one of the cleanest in all of finance. Higher American interest rates, or fewer cuts, mean a stronger dollar. Capital chases yield, and when U.S. government debt pays more, global money flows into dollars to capture it. That is precisely why the greenback has firmed through the spring rather than fading, as many forecasters wrongly predicted at the start of the year. Sticky inflation, elevated yields, and a cautious central bank form a powerful trio. For anyone betting against the dollar in 2026, this week was a painful reminder that the currency remains, for now, the cleanest shirt in the laundry basket. Across the Atlantic, the Bank of England faced its own balancing act. On the 18th of June, it held bank rate steady at 3.75%, but the vote revealed real tension. The Monetary Policy Committee split 7-2, with external member Megan Green and chief economist Hugh Pill both calling for an immediate quarter-point rise. The committee pointed to cooling price pressures, with UK CPI inflation easing to 2.8%, alongside fragile growth and geopolitical risk. Yet holding firm did not save sterling. The pound fell 0.5% against the dollar to roughly $1.32, its lowest since early April, and softened against the euro too. The lesson for traders is clear: in a world where the Fed sounds more aggressive, simply matching expectations is not enough to defend your currency. The euro tells a quieter but instructive story. The single currency has been trading around $1.16 to $1.17, near its highest since early June, and even nudged higher this week as investors embraced riskier assets. That resilience is notable given the European Central Bank's deposit rate sits at just 2%, well below both British and American levels. Analysts now expect the euro to hold a range of roughly 1.15 to 1.20 against the dollar over the next 6 months. Against the pound, the euro firmed to about 86.5 pence. What keeps the euro buoyant is partly relief rather than strength, easing energy fears and improving risk appetite. It is a useful reminder that currencies do not move in isolation. They are relative bets, and the euro is winning simply by looking steadier than its neighbors. None of this can be understood without the geopolitical backdrop. A roughly 3-month conflict involving Iran has been the invisible hand behind these decisions. When the United States and Iran moved towards ending hostilities, markets exhaled, the euro climbed to $1.16, and traders rotated back into riskier assets. But the damage to inflation forecasts was already done. Global energy prices, though they have eased from their conflict-driven peaks, remain elevated and unstable compared with pre-war levels. That single factor is why the Fed lifted its inflation projections so dramatically and why the Bank of England struck such a cautious tone. For currency markets, energy is the bridge between a distant conflict and the price you pay at the pump, in your weekly shop, and in the value of the money in your pocket. So how does this filter down? For British households and businesses, a weaker pound at $1.32 makes imports, fuel, and overseas holidays more expensive, while flattering exporters whose goods become cheaper abroad. For investors, a firmer dollar tends to pressure emerging market currencies and commodities priced in dollars, since they become dearer for the rest of the world to buy. For anyone with a mortgage, the bank holding at 3.75% offers stability, but the two dissenting votes are a warning that the next move could still be upward. The single sharpest signal of the week is the divergence in tone. The Fed leaning hawkish while inflation runs at 3.6% gives the dollar a structural edge that other currencies will struggle to overcome in the months ahead. If you remember one thing from today's analysis, make it this: in mid-2026, currency direction is being set less by what central banks do and more by what they say next. Both the Fed and the Bank of England held rates, yet the dollar strengthened and the pound weakened, purely on the difference in their forward guidance. Watch three things from here. First, energy prices, because they drive the inflation forecasts that drive rate expectations. Second, the Fed's dot plot, where 9 members now expect a hike. Third, the gap between British and American policy, which is quietly widening in the dollar's favor. Master those 3 signals and you will read the currency market far better than the headlines alone allow. Stay informed, stay skeptical, and we will track every move with you tomorrow.